Welcome, everyone, to VPOD.ai. I'm Mike, your host for today's exploration.
And I'm Susan, really thrilled to be here to help unpack today's topic.
You can sponsor this podcast for just $25. Your message will be featured across major platforms like Apple Podcasts, Amazon Music, Spotify, and more. If you're interested, visit VPOD.ai to get started today.
So, where are we starting today?
Well, I want you to imagine for a second that you decide to open a restaurant. And, in this restaurant, your pricing strategy is, well, it's a little unconventional.
Okay, I'm listening.
You decide to intentionally lose $10 on every single burger you sell.
Wow, okay, great business plan.
Right. Now imagine taking those catastrophic financial numbers to a bank, sitting down with a loan officer and having them just enthusiastically hand you $1 billion.
Just for losing money.
Exactly. Because you are, quote, rapidly scaling your user base. I mean, it sounds completely insane, doesn't it?
It sounds like financial ruin, yeah.
But welcome to the modern world of venture capital. Yeah. So today, our mission is to unpack this seemingly upside-down universe. We're looking at why billions of dollars are constantly poured into companies that just hemorrhage cash year after year.
Yet somehow they achieve the valuation of a small nation. Yeah.
Exactly. We have to figure out, have investors collectively lost their minds, or are they seeing some hidden architecture to this madness that the rest of us are just trained to ignore?
And I think the tension there is what makes this entire landscape so fascinating to analyze because, when you look at the raw numbers, traditional business logic doesn't just seem ignored. It appears to be actively penalized.
Yeah, penalized. It's wild.
Right. And to understand why $1 billion loss is sometimes actually celebrated, we have to look at how the structure of venture capital has fundamentally mutated.
And to put some concrete numbers to that mutation, let's look at the staggering data from the first quarter of 2026. Global venture funding hit roughly $300 billion in a single quarter.
Which is just a massive number on its own.
It is. But the twist here is the extreme, almost alarming concentration of that money. Because nearly 65% of it, we're talking $188 billion, went to just 4 companies.
Oh, wow. Just 4.
Yeah, OpenAI, Anthropic, xAI, and Waymo. AI companies overall captured close to 80% of the entire market. I mean, that doesn't even sound like a free market anymore.
Oh, it really doesn't.
Thousands of other startups are just scavenging for crumbs in the shadow of these 4 massive gravitational bodies,
Which points to a landscape that looks, honestly, less like traditional startup finance and much more like global geopolitics.
Geopolitics. How so?
Well, what we are witnessing is the permanent establishment of a barbell structure in venture capital. So if you picture a physical barbell, all the weight is heavily clustered at 2 extreme opposite ends, right?
Right, with basically a thin bar, virtually nothing in the middle.
Exactly.
So let's break down the mechanics of that barbell. What is sitting on the lightweight end?
So on one end, you have incredibly small, highly agile teams. Because of the explosion of new coding tools and automated testing systems, open source software models.
Things are just way cheaper to build.
Exactly. A team of 3 people in a garage can now build and launch a globally distributed product for literally pennies compared to what it cost a decade ago.
Wow.
Yeah. Their capital efficiency is just off the charts. They might only need a few $100,000 to reach millions of users.
Which is incredible for innovation.
Yeah.
But then I'm guessing those 4 companies we mentioned are sitting on the opposite massive end of the barbell.
Correct. The other end is populated by this tiny handful of frontier AI and infrastructure companies. Building at that frontier requires historic, just unprecedented amounts of capital.
Because they're doing a lot more than just renting server space.
Right. They are competing for finite global resources, they're securing advanced chips, they're hiring elite engineering talent, and negotiating for massive dedicated power grids.
It's physical.
Very physical. They function much more like national infrastructure projects. It's akin to building the Hoover Dam rather than starting a traditional software company.
I love that analogy, the Hoover Dam. They really are massive gravitational black holes just sucking all the oxygen and capital out of the room.
They absolutely are.
But if we have the scrappy 3-person teams on one side and the Hoover Dam AI projects on the other side, what happens to the space between them?
That is the big question.
Right. Say I'm a founder listening right now and I build a company right in the middle. We create a great product and generate a highly durable, reliable $50 million in annual revenue. Has my successful company just become entirely irrelevant to venture capital?
It is a brutal reality of the current market, but yes, the middle has been entirely compressed.
Wait, really?
Irrelevant.
Yeah. I mean, a company generating a durable $50 million in revenue is a phenomenal business. It's a massive achievement, and it's every founder's dream. But you have to look at the mechanical math of a multi-billion-dollar venture fund.
Okay, lay that math out for us. A $50 million company simply does not fit their required power law logic.
Let's define that for anyone, not spending their weekends reading fund prospectuses. Power law logic essentially means they don't care about a safe, modest return, right?
Exactly. It means the entire financial model of a massive fund relies on absolute outliers. If a firm invests out of a $5 billion pool of capital, a company that safely doubles their $10 million investment gives them back $20 million.
Which sounds good to a normal person.
Right. But that profit doesn't even cover their administrative fees at that scale. To return the entire $5 billion fund and actually make a profit, they need one or two companies to return 50 or 100 times their initial investment.
So they need monopolies.
Yes, they need category-defining global monopolies. So a great, profitable, medium-sized business just becomes mathematically irrelevant to their survival.
That is wild. The system basically demands that you either take over the world or you just go bankrupt trying.
That's the voting machine at work.
Which brings us back to the glaring question for you, the listener. If these funds require companies to conquer the globe, and those companies are burning billions to do it, how on earth do we assign a value to a business operating at a massive bleeding loss?
Well, Benjamin Graham, who is, one of the foundational thinkers of modern finance, he gave us the perfect framework for this.
Oh, I love Benjamin Graham. What's the framework?
He famously noted that in the short run, the market is a voting machine, but in the long run, it is a weighing machine.
A voting machine versus a weighing machine.
Right. Venture capital has basically built an entire ecosystem inside the voting machine phase. In the short run, markets vote on pure narrative.
They're voting on a story.
Exactly. They vote on momentum, the perceived size of the total addressable market, the charisma of the founders. They're pricing pure possibility.
But eventually, gravity has to kick in, right? The long run brings the weighing machine, which I imagine means looking at boring things like actual cash flow and profit margins.
Yeah, the weighing machine represents economic truth. It weighs the durability of the revenue and the actual hard cost to deliver the product.
So eventually you have to make money.
You do. But the genius, or maybe the danger of the modern venture model, is that it has engineered a way to postpone that weighing process for an incredibly long time.
And that postponement is what looks so totally absurd to anyone running a traditional business. I mean, think about a local dry cleaner.
Right.
They can't walk into a bank and say, hey, we plan to dominate the global laundry space, so please just ignore our massive daily cash burn while we are in land grab mode.
The bank would laugh them out of the room.
Exactly. So why does the technology sector get a free pass to claim that catastrophic losses are actually just brilliant strategy?
Because the mechanism protecting them is a concept we can call aspirational accounting.
Aspirational accounting. That sounds made up.
Well, it kind of is. If you think about traditional accounting like the kind your dry cleaner uses, it operates like a mirror. It strictly records what has already happened.
It reflects reality. Past revenue, past costs, actual profit.
Exactly. Venture accounting, however, operates like a prophecy. It is entirely a projection of the future.
Hold on. Calling a financial loss a prophecy sounds like a massive rationalization. I mean, if I'm losing money, my bank account is shrinking. How is that not just financial delusion disguised as strategy?
Because within this specific belief system, current losses are mathematically reframed as investments.
So they aren't losing money, they're buying the future.
That's the pitch. Getting a new user isn't just a transaction. Capturing market share is viewed as building an unfinished asset. Rapid user growth is treated as hard evidence that the company will eventually establish a monopoly.
Oh, I see.
So the present income statement, which is just bleeding red ink, is treated as a temporary construction phase on the road to permanent market power. They operate under the assumption that once they vanquish all their competitors, they can simply flip a pricing switch and turn on the profit.
Man, that feels like walking a tightrope without a net. But clearly not all cash fires are the same. There has to be a distinction between a smart way to hemorrhage cash and a completely foolish one.
Yes, distinguishing between the two is the most vital skill an investor can have today. It comes down to identifying the specific type of unprofitability. We really have to separate developmental unprofitability from structural unprofitability.
Okay, let's dig into the mechanisms of both. Start with developmental unprofitability. How does a company lose money productively?
Developmental unprofitability happens when a company's financial losses are actively translating into permanent, valuable physical or technological assets.
Assets that stick around.
Exactly. Things that will fundamentally lower the cost of doing business in the future. Think of these losses as laying down concrete.
Right, give me an example of laying that concrete.
Look at Amazon's early decades. Wall Street brutally punished them for never turning a profit. But Amazon wasn't just burning cash on advertising. They were financing an unprecedented global physical logistics network.
Which eventually laid the groundwork for their wildly profitable cloud computing business.
Yeah.
They were basically burying fiber optic cables while everyone else thought they were just an unprofitable bookstore.
Exactly.
Tesla's another perfect example of this.
Oh, absolutely. Consider Tesla's long, deeply unprofitable years, that money-funded manufacturing scale, massive learning curves in battery chemistry, and a proprietary global charging infrastructure.
Hard physical assets.
Yes. Or look at NVIDIA's incredibly expensive decade-long investment in GPU architecture and developer ecosystems. For years, that looked like a very narrow, really costly obsession.
Then the AI boom hit.
Right. And when it hit, that developmental loss had built an unassailable advantage, making them the central bottleneck of the entire global economy.
So developmental loss builds a moat. You are buying a permanent advantage. But what about the dark side of this? How does structural unprofitability work?
Structural unprofitability is insidious. These are massive losses that exist because the underlying business model simply does not work without permanent ongoing subsidies.
So it's fundamentally broken.
Totally broken. The customers refuse to pay the true, real-world cost of providing the service, or the physical operations are inherently too expensive to ever scale profitably. In a structurally unprofitable business, hypergrowth doesn't fix the core problem.
It makes it worse.
Yes, hypergrowth actually accelerates the company toward a cliff.
Oh, MoviePass is the absolute textbook case of this. For anyone who doesn't remember, they charged a flat $10 monthly fee, and in exchange, you could go to the movie theater every single day.
Such a wild time.
It was crazy. The theater still charged $15 a ticket, which MoviePass paid for out of pocket. So the more their heaviest users loved and used the product, the faster MoviePass bled out. Growth was literally a death sentence.
It's the perfect example, and WeWork executed a much more sophisticated, devastating version of that exact same structural flaw.
Oh, WeWork. How did their mechanism work?
The mechanism there was a classic duration mismatch, but hidden by accounting. WeWork took on massive, inflexible 15-year commercial office leases. Those are extremely heavy real estate liabilities.
Yeah, you can't just back out of a 15-year lease.
Right. And they then chopped up that space and rented it to freelancers on a 30-day, month-to-month basis.
Oh, that is terrifying when you actually spell it out. They were legally on the hook for a decade and a half of rent, but their revenue could legally evaporate in 30 days if the economy dipped.
Precisely the issue. But they successfully disguised this fragile real estate arbitrage by using the language of the venture ecosystem.
It made it sound like tech.
Exactly. They talked about tech platforms, community algorithms, and space as a service. They masked a stubborn physical risk as a high-run software play, and the voting machine of the market just believed the narrative.
Which brings up a crucial rule for modern business that I want every listener to burn into their brain. Just because a business operates through an app on your phone does not automatically make it a technology company.
Say it louder for the folks in the back.
Seriously. The app is just a piece of glass, you swipe your thumb, and a burrito magically appears at your door. But the back-end reality of that transaction isn't software. It's brutal, physical labor, warehouse logistics, vehicle maintenance, and complex insurance.
It's the physical world.
Yeah, when we look at giants like DoorDash or Uber, the interface is digital, but the costs are deeply physical.
And Joseph Schumpeter's concept of creative destruction provides the perfect lens for this. He argued that true capitalism requires revolutionary change. A real venture-scale business doesn't just put a sleek digital interface over an old, low-margin industry and call it innovation.
Right, that's just a paint job.
Exactly. A true technology company fundamentally rewrites the underlying economics of the industry. Companies like Uber or DoorDash can absolutely be valuable, but realizing that value requires painful operational discipline and actually changing market structures.
Not just subsidizing car rides with venture capital forever.
Precisely.
Which, kind of brings up the obvious question, right? If structural unprofitability is so dangerous, and so many of these companies are just traditional physical businesses masquerading as high-margin software, Why do brilliant investors keep pouring billions into deeply flawed models?
Well, Charlie Munger always advised, show me the incentives and I'll show you the outcome. When you map out the venture ecosystem, every single participant has a massive financial incentive to keep the narrative expanding.
Everyone is making money off the story.
Right. The founders want to avoid dilution. The venture capitalists need to show paper markups to raise their next fund. The limited partners who invest in those funds want to report strong quarterly performance.
And the media loves it too.
Oh, absolutely. Even the financial media thrives on the spectacle of soaring valuations.
It's just a closed-loop hype machine. Valuation actually stops being an observation of what the company is worth and becomes a weapon to crush competitors.
A self-fulfilling prophecy.
Yeah. A higher valuation gets you in the news, which attracts elite engineers who build better features, which attracts more capital, allowing you to subsidize prices and tell an even bigger story to the next tier of investors.
And to keep that story expanding, the ecosystem naturally begins to twist the language of finance. We see the creation of an illusion of metrics.
The illusion of metrics. Give me an example of that.
Well, standard financial terms morph from tools meant to understand reality into tools designed purely for persuasion. Suddenly, a company's gross bookings, which is just the total volume of money passing through their platform, is presented as if it's their actual revenue.
Even though they only keep a tiny slice of it.
Right. Or TAM, the total addressable market, is treated not as a theoretical limit, but as guaranteed future destiny.
My personal favorite is adjusted EBITDA.
Oh, the classic.
For anyone not staring at balance sheets all day, adjusted EBITDA is basically a company saying, here's how much money we made if you let us completely ignore all the actual expenses required to run the business.
It's almost comical.
It is. It's financial language actively being used to soften a very harsh, unprofitable reality.
The narrative scaffolding they build with those terms is incredibly effective. But the most dangerous side effect of this distortion is that it causes both founders and investors to confuse subsidized demand with genuine market traction.
Let's expand on that by distinguishing between product market fit and capital market fit. Because if we go back to the ride-sharing example, if an app offers me a ride to the airport for $15, but the driver, the insurance, and the gas actually cost the company $30 to provide, of course I'm going to take the ride.
Anyone would. It's free money.
Right. But am I using it because I genuinely value the innovation, or am I just acting rationally because a venture capitalist is secretly paying for half of my trip?
That's the million-dollar question. Real product market fit means the customer values the service enough to willingly support its true, unsubsidized economic cost.
They'll pay the real price.
Yes. Capital market fit simply means the investors are currently enamored enough with the company's story to keep injecting the cash required to artificially lower prices.
So it's an illusion.
That subsidized capital simulates momentum, and understanding how easily that illusion is created brings us directly into the massive hype cycle we are living through right now.
Yeah?
The AI era.
Oh man, it is impossible to avoid. Every pitch deck, every commercial, every earnings call suddenly features the phrase, we use AI. But slapping those words on a company isn't an actual competitive moat.
Not at all. History shows us that a technology can completely revolutionize human existence and still be a uniquely terrible investment if you fund the wrong layer of the ecosystem.
Like the internet boom.
Exactly. The internet changed everything about how we live, yet the early dot-com companies were notoriously catastrophic investments that evaporated wealth. Railroads completely remade global commerce and physical geography, yet countless early railroad investors went bankrupt.
Because they were funding the chaotic hype layer, not the durable economic foundation.
Exactly.
And with AI, the narrative treats it like it's just pure magic software floating in the cloud. But the reality of AI is intensely physical.
That is the crucial pivot investors must make. We all know AI is a transformative power. The actual analytical question is, where does the durable profit pool eventually settle?
Where does the money end?
Right. Early in a hype cycle, all the capital rushes toward the shiny new consumer applications and the foundational models themselves. But over time, as open source alternatives catch up, those models might become commoditized and highly interchangeable.
So where does the durable profit go?
Historically, the massive durable profit pools always migrate toward the bottlenecks.
Wait, so the companies that ultimately win the AI revolution might just be the ones figuring out how to keep the server farms from melting down?
Literally, yes. Generating an AI prompt requires magnitudes more electricity than a traditional Google search. So the next trillion-dollar AI behemoth might not build chatbots at all.
It'd be an infrastructure company.
It might be a specialized liquid cooling manufacturer, a company that builds high-voltage energy substations, an advanced chip architecture firm, or even a startup optimizing power grids.
Wow.
Running these frontier models requires staggering physical resources. Specialized silicon, complex land permitting, colossal data centers, and massive electrical transmission lines. The future of artificial intelligence will be dictated by access to physical raw energy just as much as by brilliant software code.
That reframes the entire industry. The software might be infinite, but the copper wiring is not.
Exactly.
Eventually, this collision with physical reality, combined with the absolute limits of how much capital can be continually set on fire, brings the entire venture system to a reckoning point.
It forces the transition from the voting machine to the weighing machine, and that is the final test. What happens to these massive valuations when the story is finally forced to meet the math?
And what triggers that reckoning?
The entire ecosystem of aspirational accounting, heavily subsidized user growth, and expanding TAM narratives thrives in one very specific macroeconomic climate: the era of cheap money.
Ah, cheap money. When interest rates are near zero, capital is virtually free, and the market is more than happy to pay massive premiums to acquire future optionality.
Let's define future optionality for a second. When money is cheap, investors are basically willing to buy expensive lottery tickets for a chance at a monopoly 10 years down the road.
But when the macroeconomic weather changes and money gets expensive,
When money gets expensive, when you can earn a guaranteed 5% return just holding cash in a bank, the fundamentals return with absolute brutality.
the party's over.
The market abruptly stops valuing the futuristic aspiration and begins rigorously auditing the current accounting. Positive cash flow suddenly matters. Gross margins matter.
Reality sets in.
The legendary investor Howard Marks captured this shift perfectly when he observed, "Trees don't grow to the sky and few things go to zero." In moments of cheap money euphoria, the venture markets draw a startup's growth curve and simply extrapolate it upward into infinity, completely forgetting that financial gravity exists.
So, synthesizing everything we've unpacked today, the new rule for corporate survival is incredibly clear. Over the last decade of cheap money, the primary commandment was always, win the market share first, figure out how to make money later.
Which is a luxury of cheap money.
Right. But today, the mandate has fundamentally shifted. It has to be. Win the market in a way that makes profitability possible. Expanding your user base has to translate into genuine, sticky market share.
And that market share has to translate into actual pricing power.
Exactly. Which must eventually result in a durable profit margin.
You know, aspirational accounting isn't inherently malicious. Valuing any early-stage startup absolutely requires a leap of faith. You have to imagine what a team is capable of building.
You have to believe in the vision.
Right. But the danger crystallizes when that aspiration lacks any credible economic bridge back to reality. The ultimate unavoidable test of any high-flying company is whether it can justify its valuation after the story meets the math, after the artificial price meets the true physical cost, and after that cost meets the final margin.
And that reality check leaves us with a truly provocative thought for you to take away today. Tomorrow, take a hard look at the convenient app-based services you rely on to get through your week.
The ones you use every day.
Yeah, the instant food delivery, the cheap ride sharing, the rapid grocery drops. Are you actually paying the real physical cost of the labor, gas, and logistics required to provide those services?
Or is a massive venture capital fund quietly subsidizing your lifestyle behind the scenes just to inflate their user metrics?
That is the big question. And more importantly, what is going to happen to your daily routine when the cheap money finally dries up, those subsidies end, and the story is finally forced to meet the math?
It's an economic reckoning we're all going to experience firsthand very soon.
Well, that's all the time we have for today's exploration. Thank you so much for joining us, and we'll catch you next time as we continue to unravel the forces shaping our world.